Front and center this hour's second half strategy. Stocks looking to extend their record run. Joining me for the hour to discuss and debate, Joe Terranova, Steve Weiss, Brian Belsky, Bryn Talkington. Check the markets here. We have the Dow, the S&P, the Russell are in the green. Nasdaq's a little bit red. Dow just clocked its best first half since 21. Made a new closing high yesterday, as you know. Russell's best first half since 1991. Let's give you the scorecard here, show you what we've done. Year to date, Dow's up 9%, S&P's up 10, Nasdaq up 13, Russell up 22. So that's the scorecard, if you will. And history is on the bull side. In July, the S&P 500 hasn't had a negative July since 2014. How about that, Mr. Terranova?
Well, I think that is going to be the theme for the remainder of 2026, the continuation of what is a bullish trend. What is interesting about today is if you had the advanced knowledge that semiconductors would be down 4%, the advanced knowledge that AI infrastructure would be down near double digits, whether it's your Corning, your Micron, your AMD, you would think, and you see the momentum factor down nearly 4%, you would think the market would roll over. But the opportunity lies in where the underperformance ultimately has been in 26. And yes, that's taking you to three sectors like consumer discretionary, financials, which have been the laggard so far year to date, but it's also finding the opportunity in the Mag 7.
Well, why would you think, so just how you laid it out, why would you think if all of those things happened that the market would, in your words, roll over? The market has been telling you for the better part of the last month that in fact is not the case, that what's turned out of tech has turned into other areas. Over the last month, the Dow's up 3%. The Russell is up nearly 5% at the expense of a Nasdaq that's down almost 4%, and an S&P 500 as a result of those mega cap stocks not doing all that much is also in the red. Market's proven that to be incorrect.
Correct from a fundamental standpoint, I agree with you. From a mathematical standpoint, if you think about the semiconductors and the AI infrastructure, they are a significant weighting of the S&P overall. The advantage that you have is, in fact, when you identify the underperformance so far in 26, the Mag 7 fall into that category. So today you're benefiting from Microsoft, you're benefiting from Meta, you're benefiting from Apple, you're benefiting from Tesla. All the Mag 7 names are now participating, and statistically, that's picking up the slack.
Weiss. So what's your outlook here? Tony Pasquarello at Goldman says his expectation is, quote, global equities will trend higher in the second half. This view is rooted in the House call that double-digit S&P earnings growth will persist through 2027. Earnings estimates are for 24.3% earnings growth. That's the consensus.
Right.
On April 1st, it was 19.2. On January 1st, it was 15.2. In other words, estimates continue to go up, which is why you get targets on the S&P that continue to go up towards 8 or at 8, if not above 8,000 by the end of the year.
Yeah, so general, I mean, it's a bifurcated economy. Forget about that for a second. What's powering the economy should continue to power the economy, which is AI spend. And when you take a look, I was looking this morning at the individual stock price performance in the S&P 500. And through the top 50 names, only 8 of them are not associated with AI. So they may not be classified as typical AI plays. Energy, for example, that's been an AI play. So they're there. The only ones that you have some healthcare companies, surprisingly.
Right, biotech, everything now is being looked at as kind of an AI play, except for, traditionally defensive-ish staple-like names.
Right. So my point is, when we talk about a broadening of the market, because of the sectors that have performed, if you go into those sectors, you'll see there's not so much for broadening. There is some broadening, but it's an overstatement to say the market's really broadened out. It hasn't. Industrials have been a top performer, but you take a look at some of the industrial names and you'll see, again, the AI trade. So that's where I think it's not as clear cut, is that while the fundamentals are strong, we don't know when the market or these stocks are going to discount peak performance of those fundamentals.
Well, the market has broadened out. I mean, over the last month, it has. It has. Financials are up 7%. They're not AI plays.
Well,
they're not.
They're not directly
they're
AI
not.
plays.
I mean, like
no,
you're
they
speaking.
are.
No, but you're speaking of pure kind of. They're not. They're not AI plays.
I think a lot of us are confident in the outlook for the Goldmans and the Morgans and the Cities because of their IPO pipeline.
That's fine,
that's what's driving it.
That's in part, but they're not traditional. They're not pure AI plays. They're not. I mean, let's not act like they are. They're not.
I'm not saying they're 100%, but that definitely has motivated the performance of most stocks. By the way, financials have underperformed broadly, right? They're down on the year as of
No, but I'm saying the character of the market over the last month has told a different story than one that the quarter played out for 2/3 of its period of time.
That is true. That is true. I'm just saying there's some cautionary signs that you should take a look at, which are that the market is more based on AI than any of the indicators would say. It's not just technology. It's not just communications. It's forever, like Caterpillar.
Well, obviously, Caterpillar's become an AI play.
Exactly. So, but most of their business is not AI. So, but anyway, I think the point of it is that the market should continue with the strength. Those types of earnings growth numbers are unprecedented when it's coming year after year. And getting 24%, it doesn't matter if it's 15%. That is still phenomenal earnings performance, and that should continue to support the market.
What do you think? You see how quickly he was ready to fight me, though?
Man, that was
Did you see that?
It's so great to be back on with Steve.
I mean, it was really quick.
That was a generous debate.
I thought it was a good debate.
It was really good.
Well, it almost went off the rails. It could have gone off the rails, but, I just didn't feel like doing that today. I did, right?
He never came in with the right.
Doing that.
Jab, jab, jab. He could have came in with the right, and he needed to.
Hey, fans paid for the whole hour.
But then he'd be laying on his back over by you on the floor. Go ahead.
So, no, we actually do believe in the broadening, and you know that I'm going to talk about financials. If you take a look, financials up double digits in the S&P 500, up 14% in the small mid-cap marketplace in June and in the second quarter alone. That's broadening out. You look at small cap, like Russell 2000 up 22%. If you look at the S&P 600, small cap up 19%, the mid cap up 16%. Only in the second quarter. That's broadening out. And oh, by the way, performance. But if you take a look at price to free cash flow and return on invested capital and actually dividends, the small cap world looks really, really, really interesting. So we've been small cap bulls for a while. We're vindicated in the second quarter. We think this is going to continue. Oh, by the way, because if you're talking about 24% earnings growth in the S&P 500, small cap earnings is up 28% for the second half. So we still like that area.
The moral of the whole story here is that tech is the wild card. It's the obvious question mark for the second half. Does it outperform? Do other areas of the market pick up the slack? Bryn, I'll throw that one in your direction. There's no foregone conclusion. I think we pretty much figured that in the first half of the year, tech was going to be the story for all of the reasons that we've laid out, the AI build out and everything else. The question is, does that continue?
Yeah. I think you have to say, Scott, what part of tech? Microsoft is tech, Meta's tech. They've had a horrible first half of the year. And so I think we have to discern that a little bit more and say, will semis and memory outperform, or will software and those Mag 7 contingents of software outperform? And so I think that, to me, is the million-dollar question. When I look at software, just look at IGV, it looks very clear it put in a bottom in the mid-70s, and now it's making higher lows. It's not making higher highs, but it's making higher lows. And so I feel that there's been a base built within IGV. I think you're going to start seeing a rebuild of that, which benefits cyber, benefits Palantir, Microsoft, et cetera. But I also think when you look at momentum, and especially memory, if you look at Micron or the ETF DRAM, really, they're just bouncing off the 21-day moving average, really like clockwork. And so although we've had this drawdown, they're still like right at the 21-day moving average. And until you get below that, I think that trade actually stays in place. And on top of that, in the next couple of weeks, we'll have SK Hynix have their ADR debut in the U.S. I think that's going to be huge for retail, huge for hedge funds. And so I think you're going to have both trades somewhat working, but just working at different time periods, because you really need to see that 21-day bounce off DRAM and memory, and that IGV, which is that basket of tech names, continue to build those higher lows.